All right, let's just dive right into this explainer. We're going to completely demystify the Canadian heavy equipment financing landscape for your business. Because look, whether you're moving earth, harvesting crops, or running an industrial site, getting your hands on the right iron is absolutely everything.
If you're a contractor, a farmer, or an industrial business owner running a crew, you know exactly what I'm talking about here. Heavy iron is incredibly expensive, and when you need a machine to finish a job, you need it right now. But buying it outright? That severely ties up your precious working capital. So where do most of us go first? The bank, right? But man, traditional banks can be a massive headache. You're usually looking at these lengthy, confusing application processes, strict limitations on the types of equipment they'll even consider, and painstakingly slow approvals that can drag on for 2 to 4 weeks. I mean, while you're waiting on some banker's committee, your job site is just sitting idle. And if you're trying to buy older iron, you might just get an outright rejection. No way around it. We know this is a kind of complicated space, so here's our easy-to-follow game plan for this explainer. We'll cover the heavy equipment dilemma, why choose equipment leasing, the 3 lender categories, understanding your rate bucket, and finally, navigating the fine print.
Okay, Section 1, the heavy equipment dilemma, cost versus working capital.
The reality out there on the ground is just stark. Whether you're harvesting crops at sunset or literally moving earth for a new development, the equipment you need represents a massive capital outlay. You're essentially forced into this tight corner, choosing between buying the gear to do the job or keeping cash on hand to actually run your daily operations.
To really put this dilemma into perspective, think about the cost of simply renting when you don't have the cash to buy. Based on current market rates, renting a piece of equipment, let's say a Case 1650 bulldozer, that can cost you $7,000 for a single month. That is a huge cash drain just for temporary access. And honestly, bleeding cash on rentals isn't a long-term strategy for scaling your business.
Which brings us to Section 2. Why choose equipment leasing? The strategic alternative.
Let's actually shift our perspective here, from seeing a massive cash drain to looking at a strategic financial tool. Buying outright drains your working capital immediately, leaves you stuck with aging technology down the road, and ties up the cash you desperately need for operations. But leasing? Leasing offers predictable fixed or variable costs. Depending on how your business is set up, payments can even be 100% tax deductible, and it gives you the flexibility to upgrade your gear or even align your payment schedule with your seasonal revenue.
So, the absolute game changer here is that leasing preserves your working capital. And beyond the tax perks, specialized leasing partners can get you approved incredibly fast. We are talking same-day application reviews and approvals in 4 to 24 hours. Your vendor gets paid within 24 hours, so you can get back to the field without missing a beat. Plus, these specialized lenders often have 0 restrictions on the equipment's age or class.
Moving on to Section 3, the 3 lender categories, and what you're not being told. This breaks down the absolute inside scoop. Your rates and your approval speeds, they depend entirely on which of these 3 doors you knock on. Big banks and captive lenders offer the lowest rates, sitting around 6.5% to 10%, but you need stellar credit and you're going to wait weeks. Equipment finance companies sit right in the middle, perfect for used equipment and mid-tier credit, approving in just days with rates from 8 to 14%. And private lenders, they charge 12 to 22%, sure, but they fund really quickly for challenged credit and older iron. This is the core issue that trips up so many operators out there. The folks at Iron Finance hit the nail right on the head. The mistake most contractors make isn't applying for the wrong rate, it's applying in the wrong lender category first. If you take a 580 credit score and an older machine to a Big 5 bank, you don't get a bad rate, you get an outright decline, literally wasting weeks of your time.
All right, Section 4, understanding your rate bucket, how your numbers dictate your terms.
Now, before we look at your specific rate, remember that equipment loans don't just exist in a vacuum, right? They are anchored to larger economic forces. As of June 2026, the Bank of Canada's policy rate is held at 2.25%, which makes the prime rate 4.45%. This is the baseline that all those lender categories build their pricing on top of.
At the end of the day, your specific business profile dictates everything. Your credit tier dramatically shifts what interest rate you can expect. An excellent score takes you as low as 6.5%. A good score sits around 8 to 10.5%. But if your credit is a bit challenged, you're looking at 13 to 18%. It's the exact same machine, but a very different cost of capital depending entirely on your financial health.
So who actually falls into that higher rate private lender bucket?
Well, if your business has credit scores below 640, or you're purchasing equipment older than 15 years, maybe you're buying via a private sale instead of a certified dealer, or you've just been in business for less than a year, you're going to be in the private lender bucket. And what you should really take away from this is that while it means higher rates, sometimes up to 22%, these private lenders will actually approve the files that traditional banks reject. They literally keep the industry moving.
Finally, Section 5, navigating the fine print, the real-world contract obligations.
When you look at a genuine commercial equipment lease agreement between a heavy equipment rental company and a contractor, one thing becomes crystal clear. Commercial leasing is fundamentally an as-is arrangement, and I really can't stress this enough. When you sign, the lessor makes absolutely no representations or warranties about the equipment's condition or if it's even suitable for your specific job. You are taking on that iron exactly as it sits, warts and all.
These are the actual things you are legally bound to do the second that machine is in your possession. You aren't just paying a monthly rent here. You've got to supply certified copies of liability insurance, which often exceeds $1 million. You pay all operating expenses. You are entirely responsible for the daily greasing, the maintenance, and repairing the equipment. And crucially, you assume absolute risk for any liability loss or damage. You are completely on the hook for the whole shebang.
In these contracts, they are definitely not vague handshake deals. The paperwork gets incredibly specific, tying your monthly payments and all of those heavy legal liabilities to exact makes, models, and serial numbers, like a 2008 Manitowoc 8500 crawler crane, for example. Every single detail is locked down tight.
So before you sign your name on your next equipment lease, you really have to ask yourself a tough question. Are you leveraging finance to actually build wealth, or are you just renting the privilege of doing the heavy lifting? Now that you know the inside reality of lender tiers and lease obligations, you've got the tools to use financing strategically. Having the right lender strategy, it literally changes everything. See you in the next explainer.